Welcome back to Yield Report Daily. Today we are covering something that millions of people receive regularly but many have never fully understood: your pay stub. Whether you get a paper pay stub with your check or a digital one through your employer's payroll system, every line on that document is telling you something important about where your money goes. By the end of this video, you will know exactly what each section means and how to use that information to your financial advantage. First, why does this matter? The gap between what you earn and what lands in your bank account can feel like a mystery, especially when you are new to the workforce. Understanding your pay stub closes that gap completely. It also helps you verify that your employer is withholding the right amounts for taxes, catch errors before they cost you money, make smarter decisions about your benefits and retirement contributions, and understand your overall compensation picture more clearly. Let us start from the top. Most pay stubs are divided into a few main sections: earnings, deductions, taxes, and net pay. We will go through each one. The earnings section shows what you were paid during the pay period before anything is taken out. If you are a salaried employee, you will typically see your gross pay for the period, which is your annual salary divided by the number of pay periods in the year. If you are paid bi-weekly, that means 26 pay periods, so your gross pay per period is your annual salary divided by 26. If you are paid semi-monthly, that is 24 periods. Hourly employees will see their hours worked and their hourly rate, with regular hours and any overtime listed separately. You might also see additional earnings lines such as bonuses, commissions, holiday pay, or paid time off that was used during the period. All of these add up to your total gross pay for the period. Now we move to taxes. This is where most of the gap between your gross pay and what you take home comes from. There are typically several tax lines on a pay stub, and it is worth understanding each one. Federal income tax is the amount withheld for the federal government based on your income and the information you provided on your W-4 form when you were hired. The W-4 determines how much federal tax your employer withholds each period. If you claimed zero allowances or dependents, your employer withholds more. If you updated your W-4 to reflect dependents or other adjustments, they withhold less. If your withholding is significantly off from your actual tax liability, you will either owe money or receive a refund when you file your annual return. Many people treat a large tax refund as a bonus, but it is worth understanding that a large refund simply means you overpaid throughout the year and gave the government an interest-free loan. State income tax appears on pay stubs in most states. Some states have no income tax at all, including Florida, Texas, and a handful of others. If you live in a state with income tax, this line will reflect what your employer withholds for your state government. Social Security tax is a flat rate applied to your earnings up to an annual wage base that adjusts each year. The employee portion of Social Security tax is 6.2%. This funds the Social Security Retirement and Disability Program. Medicare tax is a flat rate of 1.45% on all of your earnings with no wage base cap. Above a certain income threshold, there is an additional Medicare surtax, but this affects higher earners. Together, Social Security and Medicare taxes are commonly referred to as FICA taxes, which stands for the Federal Insurance Contributions Act. When you hear people talk about payroll taxes, FICA is what they mean. After taxes, we come to deductions. These are amounts taken out of your pay that are not taxes, but rather contributions to benefits or programs. The most common ones are as follows. Health insurance premiums are the portion of your health insurance cost that you pay. Most employers cover a significant portion of the premium, and you pay the remainder, which comes out of your paycheck pre-tax if the plan is set up that way. Retirement contributions are amounts you are putting into a workplace retirement account, most commonly a 401k. If you have elected to contribute a percentage of your pay to your 401k, that amount appears here. These contributions are made pre-tax in a traditional 401k, meaning they reduce your taxable income for the year. We have a dedicated video on 401k accounts on this channel that explains this in more depth. Flexible spending account or health savings account contributions may also appear if you have elected to participate in those programs. Both allow you to set aside money pre-tax for qualifying medical expenses. Life insurance and disability insurance premiums, if your employer offers these benefits and you have elected coverage, may also appear as deduction lines. There is an important distinction between pre-tax and post-tax deductions that is worth understanding. Pre-tax deductions, like most health insurance premiums and traditional 401k contributions, are subtracted from your gross pay before your taxable income is calculated. This reduces the income you are taxed on, which is a genuine financial benefit. Post-tax deductions are taken out after taxes are calculated and do not reduce your taxable income. Roth 401k contributions are an example of a post-tax deduction because you contribute after-tax dollars now in exchange for tax-free withdrawals later. The last section is net pay, which is what you actually receive. Net pay is your gross earnings minus all taxes and deductions. This is the number that hits your bank account. If there is ever a discrepancy between your net pay on the stub and what was actually deposited, flag it with your payroll or HR department immediately. Most pay stubs also show year-to-date totals alongside the current period figures. The year-to-date column shows cumulative totals for earnings, taxes, and deductions from the beginning of the calendar year up to the current pay period. These are useful for tracking your total income and total taxes paid so far in the year, which can help you estimate whether you are on track with your withholding and whether any adjustments make sense. A few practical things worth checking on your pay stub regularly. Verify that your retirement contribution rate is correct, especially if you recently changed your election. Check that your health insurance premium deduction matches what you signed up for during open enrollment. If your earnings include any new pay rates, bonuses, or changes, confirm they are reflected accurately. And if anything looks wrong, the payroll department can usually resolve errors quickly, but you have to catch them first. Understanding your pay stub is one of those foundational financial skills that pays off every single time you use it. It gives you visibility into your full compensation, your tax situation, and the progress you are making toward your financial goals through retirement and benefits contributions. As always, nothing on this channel is financial advice. We are here to educate and help you understand how the financial system works so you can make smarter decisions for yourself. If this video was useful, please hit the like button and subscribe. We publish new personal finance videos twice a week. We will see you in the next one.